Are you prepared to discover the secrets to successful investing? Well, you're in for a treat because today we're revealing the secrets that will revolutionize your investment game. Investing isn't just about blindly putting your money into random stocks or following trends. It's a strategic approach that requires a savvy approach. That's exactly what we're here to reveal: the secrets that will unlock your investment success. Welcome to the Finance Virtuoso Channel, where we talk about all things finance. If you're seeking a daily dose of valuable information on money, business, investments, and savings, be sure to click the notification bell and hit that subscribe button now. Let's dive in so we can get started with making that money work for you. Starting with secret number 1. The first proven strategy for successful investing is to approach the market on your own and skip the middlemen. Studies have shown that typical individual investors in individual stocks are falling behind the market by around 2.5 percentage points per year. Let's put it into perspective. If we take the annual return of 12% over the past 25 years by the S&P 500 stock index, the average individual investor's yearly return is actually less than 10%. That means they're only getting about 80% of the market gains. If you're a typical mutual fund investor, the situation may be even worse. Many mutual fund investors face high fees and expenses that eat into their returns, leaving them with subpar results. If one investor gains more, another loses an equal amount. So, before even factoring in costs, outperforming the stock market is essentially a zero-sum game. Now, what about those pesky expenses? They trim winners' gains while amplifying losers' losses. Who benefits? The intermediaries: brokers, bankers, managers, marketers, lawyers, accountants, and the financial system as a whole. The financial middlemen consistently come out on top, amassing a staggering $400 billion per year from investors like us. It's akin to the casino's favor in gambling or the state's victory in lotteries. Investing follows a similar pattern. After accounting for these expenses, prevailing against the stock market is tough. Despite promises of easy wins from investment guides, reality often tips the scales in favor of losses due to these costs. Secret number 2. The second proven strategy for successful investing revolves around avoiding excessive trading. This advice stems from a fundamental observation: the power of compounding returns, which transforms the profitability of businesses into impressive stock market gains, can be outweighed by the cost of investing. These costs, in various forms, tend to erode the gains and leave investors with less favorable outcomes. Meet Alex, an investor who constantly monitors market trends and makes frequent trades based on the latest news. Despite his efforts, the costs of these frequent trades, including transaction fees and missed opportunities, end up eroding his gains. Meanwhile, Sarah takes a more patient approach, making fewer trades and capturing the market's steady growth over time. Attempting to outsmart the market and engage in frequent trading is a common pitfall. It might seem like a smart move to swiftly react to market trends or news through rapid trades, but this approach often leads to unsatisfactory results. In reality, the average trader typically falls far behind the stock market's long-term returns. You might believe that by conducting thorough research and executing quick trades, you can sidestep these investing challenges, but it's essential to reconsider. Investors who engage in fewer trades actually have a higher likelihood of achieving returns that mirror the market's performance. On the flip side, those who engage in excessive trading often find themselves in a disadvantageous position. This reality is backed up by an academic study that investigated the performance of the most active stock traders between 1990 and 1996. Although these traders initially earned an impressive market return of 17.9% per year, once trading costs were factored in, their annual return dwindled to a mere 11.4%. This outcome represents just 2/3 of the gains witnessed in the flourishing market during that period. In essence, the allure of frequent trading is often outweighed by the financial toll it takes on returns. Secret number 3. Now on to the third secret. Embrace diversified ownership across the entire stock market. The bedrock of this approach is rooted in both logical thinking and historical evidence, which consistently demonstrate that investors who secure a substantial portion of their returns from dividends and earnings growth are more likely to achieve success. But how can you adopt this strategy without feeling overwhelmed by the complexities of the market? This is where the concept of investing in index funds comes into play. John, for example, decides to invest all his money in a single tech company he believes will skyrocket. Unfortunately, the company faces unexpected challenges, and John's investment takes a nosedive. Contrastingly, Lisa invests in an index fund that includes a wide range of stocks across different industries. While some stocks may decline, others perform well, resulting in more stable returns for Lisa. By investing in index funds, you gain exposure to a wide spectrum of stocks, thereby mitigating the risks associated with individual stocks or specific sectors. This approach allows you to benefit from the overall growth of the market while minimizing the potential negative impact of individual stock fluctuations. While index funds may not provide immediate thrills, their long-term potential, driven by the compounding of returns, is genuinely impressive. Picture a classic index fund. It boasts broad diversification, minimal expenses, lack of advisory fees, low portfolio turnover, and high tax efficiency. This combination of attributes translates to the fund effectively claiming a stake in the massive $15 trillion valuation of the US stock market. Embracing this diversified strategy means you can tap into the collective growth of the market while substantially reducing the risk associated with relying heavily on a few specific stocks. In essence, it's a pragmatic way to harness the benefits of market growth while safeguarding against excessive risk. Secret number 4. The last secret is to exercise prudence when placing your trust in financial advisors. Now, before you interpret this as criticism toward financial advisors, let's clarify. While they can certainly provide valuable insights, it's crucial not to place exclusive reliance on their recommendations. Jessica, for example, relies solely on her financial advisor's recommendations, investing in high-fee funds that promise big returns. Over time, the fees eat away at her gains, leaving her with less than expected. On the other hand, Mark does his research, focuses on low-cost index funds, and manages his investments independently. He avoids unnecessary expenses and enjoys more significant long-term gains. It's a common scenario. Many investors find themselves burdened by high fees and expenses, often without even realizing that these costs are chipping away at their returns. In contrast, adopting a straightforward and cost-effective approach can be far more rewarding. Place confidence in your own judgment and prioritize businesses that demonstrate substantial returns on their capital. Investors who steer clear of unnecessary expenses and demonstrate patience with their investments significantly increase their chances of success. The core lies in directing your attention towards businesses that consistently generate significant returns on capital and regularly distribute dividends. While it's true that certain companies may falter, the essence of successful investing revolves around sustained long-term growth and the inherent potential of the businesses in your portfolio. And that's all for today. We hope you're feeling pumped and ready to conquer the world of investing. If you enjoyed this video and found the information helpful, don't forget to give it a thumbs up and share it with your fellow investors. Let's spread the knowledge and empower others to take charge of their financial destinies. Now, get out there and let your money start working for you. Until next time, happy investing.